It's about that time again where we take a look at the charts to see how overleveraged we may be. Stocks are soaring because corporate earnings are going to rise even faster, but are we nearing the peak of a long cycle? We see that interest rates are heading up with inflation stirring about, and government deficits are more common than a Hollywood divorce. As in the 1970s, 1980s, 1990s, and the 2000s, we're nearing a point where share prices have to restore balance. And the only way to restore balance is with a stock market pullback. But the big question, as always, is where is the balance? Frankly, I don't really know. What I know is that now is the time to be very, very cautious. So let's take a look. There are dozens of charts that we could use to show how today's financial bubble resembles the stock market peaks of prior bubbles. But let's keep it simple. And that means we first take a look at the old tried and true chart of margin debt. Just quickly, margin debt is created when overly optimistic investors borrow against their stocks to buy more and more and even more stocks. From the prior bubbles, the result of extremes is generally the same. And as you should know, the price declines that forces over-leveraged investors to liquidate at any price can turn a correction into a bloodbath. And this was the case back in March of 2020 with the coronavirus outbreak. And as you can see by this chart here, the steeper the rise in margin debt, the more severe the resulting plunge in share prices can be. This chart here gives you a better idea of the steepness of the climb in margin debt, at least going back to 1995. There is no climb as steep as the climb we are making now. It's the Mount Everest of margin debt. Be mindful that it's not necessarily how high the margin debt has become. The real problem is how fast the margin debt is built up. And as you can see, the debt has come pretty quickly here this time. Now, during the past spikes in margin debt, the investors who were swept up in the euphoria of easy money frequently responded to criticism with a variation on corporate earnings are about to soar. That will bring everything back to balance. Well, I'm not so sure about that. It didn't happen in the dot-com bubble, and it didn't happen in the great financial crisis. So I don't see anything that says it's going to happen this time. What I see is a margin debt that has climbed like no other climb that we have seen. At least in the past, corporate earnings almost never completely offset extreme valuations and soaring margin debt. And so we look at this chart as a useful measure for visualizing this fact. This chart shows the earnings yield, which is the S&P 500's aggregate earnings expressed as a percentage of its aggregate market cap. And the chart shows how much a buyer of the average stock receives in earnings per dollar invested. Historically, the more an investor receives in yield, the better the deal. On the other hand, the less an investor receives in yield, the higher the likelihood the stock prices will fall in the future to make up for that fact. And so today's yield of 2.36% is the second lowest ever, and that's not good. But don't use these as timing tools. However, these indications should be a warning to an observant investor. You may make money on the way up, but that's the easy part. You lose money on the way down, and that's what we try to avoid. But you know me, I'm always early. However, as I've learned, it's better to be a day, a week, or even months early than a day late. And so for today, that's ChewDog Charts. Thank you.